Right, hello everybody. My name is Pilley, I'm from CXG, and I'm just going to tell you a little bit about my personal journey today, and also hopefully give you some good property investment tips. So a bit about me. I started really just with a mobile phone and a car. The mobile wasn't an iPhone and the car wasn't a Ferrari. But my remit at that particular time, and we're going back about 15 years now, was to go out there and find some properties for my brother and I pensions pot, because we actually owned a retail business which had started to decline as the internet came in, because we were computer based, so we saw our financial future sort of disappearing before our eyes. So we felt at the time it was a good idea to get some buy-to-let properties to basically give us a pension in about 15-20 years time. But what I started to realise was that it was also a very good way to create cash flow, because we started to actually rent them out on a per room basis at that time, which now we know as HMOs, houses of multiple occupation. So our rental income was about £1,500 to £2,000 on properties we were purchasing for about 100,000. So that's what I did. I went out there, got a few properties. At the time I didn't know too much about no money down deals, etc., so I started to run out of deposits. But when I explained to my mortgage broker what I was actually doing, he's told me that there would be investors very much interested in what I was doing, because we were achieving net returns of between 8 and 10%. And he said that was obviously a very good high return, excellent cash flow. We were cash flowing about £1,000 per property. So he actually introduced me to somebody. Again, all I had at that particular time was just the phone and the car, but I also had a hell of a lot of passion, which I think came through and gave them the confidence that I could deliver for them. And it turned out that that first client of ours had about £1 million to invest, so they were able to employ me to go out there and get them 10 properties and really replicate what I was doing for myself for them. So from that kind of little acorn, we managed to grow a business which, as you can see there, we now manage over 200 properties. We've sourced the last couple of years over 100 properties for our investors, and we've won 15 awards in the last 8 years. As a result of that, I got invited to Downing Street, so our brand has really grown. So the first sort of tip that I learned, which I think is very, very important for investors, is that always to buy for cash flow, because no matter what the market, if you're buying for cash flow, then you shouldn't be creating yourself too many issues. So this actual example is when I talked about that first property that we saw for about 100,000, this is the estate that we were purchasing on. So the stamp duty threshold kicked in at about 125,000. So I actually would only buy 3-bed properties up to that value to save the stamp duty. Negotiate about a £10,000 discount for our investors, and as you can see there, the rental returns were between £600 up to £1,200, depending whether you were letting it out as a family let or as an HMO. So we sold those properties very, very well. Then the financial crisis came, and you can see they nearly halved in value, or they went down to about 80,000. Now, of course, as you can see by the rental income, which obviously was actually going up, because rental incomes never really got affected by the financial crisis. If anything, they continued to rise. So my actual cash flow, of course, was increasing. But we found it difficult to sell to investors, because investors said, well, we're only going to buy at a 20% discount. So at 80,000, that's a market value. Why should I buy that property? What they forgot was that you should be buying for cash flow. So me and my brother went back into the market and bought those properties for about 80,000, which you can see in the last 3 or 4 years have doubled. So our cash flow obviously went up, and our equity gain increased very, very quickly. And now we're beginning to sell those properties very well at about 150,000, because we can now negotiate a discount. So it's really, that slide just proved to me the absolute fundamental of property investment should always be cash flow, and a lot of people don't learn that lesson. They say, I only buy if it's a 20% discount, and they lose sight of the fact that in the credit crunch, when people only bought for that on that strategy, what actually happened was if the property value decreased by 20%, their equity would be wiped out, their mortgages suddenly become unserviceable and they lose the property. Whereas again, the properties that I bought, mortgages obviously came down, and again that really helped cash flow. So again, another valuable tip is to how can you enhance the value of your product? If you're not buying it at a discount, and that gets harder to do in the south at the moment, can you enhance it? So this is just a little example of a pub that we bought for £300,000. It wasn't discounted at all because that was the market value. No one else wanted to purchase it because it looked like it needed a lot of money being spent on it. It did. It needed about £150,000 spent on it. But what we did was we converted it into our offices. As you can see there, that gave us quite a big presence in our local high street, and above it we made 6 flats. So our rental income actually serviced our business, and the asset value of that property went from 300,000 to 850,000 within the 6-month refurb time that we actually took to finish the project. So again, very, very important when you're purchasing property, have a look, can you enhance the value? So areas, where should you be looking to invest? A lot of people down here now in London are worried about a London bubble, worried about yields reducing. So we've looked over the last couple of years at the north because the returns are higher, you can still get a good market discount, and the capital growth opportunities can be greater. And the reason for that is that they're still about 40% below the peak, whereas in the south we've gone about 40% above. So the differential is as high as it's ever been, and history tells us that should obviously narrow, which shows that there should be good capital growth in the north of the country. Also, there's a lot of regeneration going in there. So for serious investors, again, it's becoming quite a good area to purchase in. Now these were just some of the headlines that I just cut out of the paper really to just show again that house price boom spreads to the home counties. Manchester went up by 18% because a lot of people feel that if you're not buying in London, it's like you're trying to sell something in Mars or Venus. Well, some of these places are only a train ride away, and you're still actually in the UK under all of our laws and regulations, etc. So you know the investment can be as safe as purchasing down in the south. So what should you invest in? What sort of product should you be looking at? There's a range of products there. With the bottom right hand corner is just a traditional buy-to-let property. We've got some studio lets there on the left hand side, and we've also got an HMO, which is the middle slide. So you know, again, the range of what's on offer at the moment is vast. It's growing all the time. So this is just an example of an HMO. As I say, I kind of grew up on HMOs. That's what obviously got me started. So for this particular HMO, as you can see from the slide before, that middle slide, the inside, they're refurbed very, very nicely. So one of our investors, this is sort of a live example, purchased this for 330,000, got it valued at 350,000 before they'd even gone to purchase. So they made a quick 20 grand equity gain, and they generated over £40,000 worth of gross rental income. So the gross yield is about 12% there. So again, HMOs can be great cash generators. So, what are the benefits of HMOs? Well, you achieve higher rental income, probably double what you would on a traditional family let. It's a niche market. Normally, if you're in a niche market, you should be capturing that market because you're offering something that not many people do. There's less voids. What I mean by that is that if you've got 5 rooms, unlikely that all five will be empty, whereas on a traditional family let, if the whole house is empty, obviously there's no income coming in, and you can get good capital allowances. And also it's a growing market, there's more demand from both tenants and landlords. The considerations, things you should be aware of: furniture package. Are you offering one? If you're not, where are they going to sleep? Some of your tenants might not have beds. There's more management. Trying to get 5 people to get on is not particularly easy. If you look on your mobile phone and try and pick out 4 people you'd like to live with, you'd be struggling. And if you looked at the person next to you and picked out 4 from his mobile phone, you'd be really struggling. So it's not easy putting people together who in effect are strangers and expect them all to get on. So you need to have quite good personal skills to make sure that you're profiling your tenants correctly. Fire safety, obviously there's more legislation involved in doing HMOs. You want to sleep at night, you don't want to feel that you're putting yourself on risk of a manslaughter charge if there's a tragedy that occurs. Financing arrangements, you must be aware that you must make your mortgage provider aware that you're actually letting out an HMO because the lending criteria is different. The example I used before and the one that we actually used for the pub, we used a bank called Shawbrook, who have been who actually like HMOs. They're a commercial lender and we work very, very well with them. Also solicitors, they need to be aware that what you're doing. So invest in student lets, is that something that you should do, or why should you invest in student lets? It's very important you know the developer you're using, that they're trusted and got an actual track record. Also that the entry points can be low, so if you're looking to build up a pension, they can be quite nice investments, and it's an armchair product. Normally a lot of developers will offer a guaranteed return to the investors. Now, invest in Paradise, or invest in, this slide is actually Cape Verde. Once you start to broaden your horizons, as we looked at the north, then you can start to look all around, and there can be some fantastic opportunities, not just in this country. That slide is actually, as I say, based on development in Cape Verde, which we're now representing. And as you can see from there, you've got absolutely quite low entry points from £10,000 right up to buying whole villas. Now, this particular company is a global company. It's got a good track record. You've got fantastic tax efficient way of investing in your money there, because your rental income is paid into your bank account tax-free, and also you can actually open a deposit account there, which gives, I think, between 3 and 5%. So there is real good opportunities all around, as long as you're partnering with the right people. So we'll quickly go through my little tips here. Always buy for cash flow. I think that's a very fundamental thing that you must get right. What is your return? Invest for the long term. Property has always been a safe investment on the long term. I think they say since Hadrian's Wall was built, about 1,000 years on average, property doubles every 10 years. So if you're looking for long-term investment, it's a good safe investment. Be realistic about your maintenance costs. Spoilers break down. Factor things like that in. Negotiate a discount if you can. Research the location. We saw some ideas there on the slide before. Look for a property that you can add value, if that's what you're wanting to do. If you're wanting to actually pull money out quite quickly, can you actually add value to your product? Remember, you're creating a business. A lot of people don't realise that. Because I came from a sort of business background, that's how I looked when I started. So I looked at the fact I would need to invest, because you do need to invest if you're starting a business. So I invested money and had a plan to obviously take money out over a period of time. I didn't look to become a property millionaire overnight, and some people go into property thinking that's achievable and make mistakes and get caught out. So remember that you are actually developing a business. Also value your time. Because in a business, you know, a lot of people won't say, oh, I manage the property, I paint the wall, I do all of these things, I cut the grass, where in actual fact, if you outsource, you create the time to hopefully do the enjoyable bits about property. Have a passion for what you do. If you don't actually enjoy what you do, then things become a lot more difficult. So I had a real passion for property, and I didn't really have a passion for the retail business that I started off with, and that was a big differential to me. It enabled me really to keep going when times were more difficult, or I've overcome obstacles quicker. So put value on your time, which is what we were talking about, whether you can outsource it. And then obviously I say choose CXG because we offer the most of these things, but that's a little bit light-hearted as well. Some people like to do things themselves, but basically our company is set up to help investors who actually do value their time and don't want to be already doing, so they're quite happy to outsource most of these things to us. So that's where I've put down now. I hopefully do what I preach. I've enjoyed a lot of the things I've done, met various people. You can see there the Prime Minister, the old President of America, Bill Clinton there, and I wrote a book with David Gold, who actually owns West Ham and Ann Summers, and that's the signing on day. So you can, once you never know, basically, if you start your journey, where it's going to lead, because I never envisaged that I'd be meeting all of those people. So have a vision and an aspiration. So our vision is to basically partner with our clients, partner with developers to become the #1 property sourcing company in the UK. So everyone should have a vision when they start. That could be financial freedom. It could be in 3 years' time I want to be earning as much for my property portfolio as I'm actually getting paid for my employed role at the moment, because I want to switch over. So that was actually important. So my goal when I started was obviously to generate enough money to give me the time to do things that I enjoyed doing, and when you actually reach that, it's a fantastic feeling. So is the time now? Well, I'd say we haven't been in such a time where interest rates are so historically low. They're about as low as they've been for 300 years. Rents are high and increasing, which means obviously your return, your yield is going up all the time. There's still discounts achievable in some areas. Property prices continue to go up. I think they're predicting another 10% increase this year. So it is a fantastic time to look to invest in property. Right, now if anyone